Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Dan Oliver, who heads up Myrmikan Gold Fund. Aside from heading up Myrmikan Gold Fund, Dan is also the director of a Committee for Monetary Research, and he holds a law degree and an MBA from a couple of very prestigious schools, and most importantly is also very well versed in free market economics, which helps in his understanding of gold, and as a gold fund manager, that certainly makes a lot of sense for him to have that background. And I might just mention a more complete bio can be read, Dan's bio, a more complete bio for Dan, at my page at the Voice America Business Channel, so the Turning Hard Times into Good Times page at Voice America Business Channel, a bit more on Dan's background. Welcome, Dan. Thanks for joining me again.
Well, thanks for having me.
Always good to talk to you. I really enjoyed, by the way, the last CMRE, the Committee for Monetary Research and Education. A lot of very prestigious people there, including former Fed Chairman Paul Volcker was there. So it was a very, very entertaining evening. Are you expecting to put together another show, another one of these conferences anytime soon? Are you going to do it next year? Or when?
Yeah, we'll probably have the next one in October, barring anything dramatic happening. The last meeting will be put on the internet, on our internet site soon. It's not there yet, but it should be soon. And I think, Paul Volcker's performance was very interesting. One of the things he said that I think made the news was that gold is the enemy, or at least the news within hard money circles. And that's not a surprise to hear him say that, but or that he thinks that. It was somewhat surprising. I thought they actually came and said it. But what I thought was really maybe the highlight of the evening was Tom Hoenig, who's the vice chairman of the FDIC. And as you may recall, Larry Parks challenged him a bit on the derivatives and the scale of these derivatives. I mean, no one has an accurate count anywhere between 800 trillion and 1.5 quadrillion, which is, of course, insane. And one would think that perhaps a man in his circumstance, who's very much part of the system, would come up with some defense of that practice. And he didn't. He admitted that he didn't see any business purpose to it. And his great fear is that the banks are working to undermine some of the restrictions that were put in place after the financial crisis. I'm not for regulation in general, but I do think that the banks already have a privileged position in law by being able to engage in fractional reserve lending, and then they take that privilege, legal privilege, and they lever it up with these derivatives. So I think that was an important thing to have someone of his stature say, and I certainly hope that we keep focus on those issues.
Yeah, of course, he wouldn't want to go back to the reason why the whole system could expand as it was, because it had, there was no limits, there was no anchor, as we once had, to the system that allow it to expand. So, I mean, it's infinite, right?
Well, you can't get a fellow like that to say that on record, of course. But I think I might have mentioned this to you before. One of the things I was interested in was that he is very much in favor of raising reserves. Now, a lot of hard money people would say, well, the only stable banking system would be one that has 100% reserves. Well, okay, we're not going to get there probably under this monetary regime, but certainly moving it from where it was, which was probably 3 to 5% up towards 10%, is probably better. I mean, it certainly doesn't solve the problem, but it might mitigate the scale of bubbles that the bank system could produce if, of course, the reserve ratio goes higher. And he's working on that, so he's at least heading in the right direction.
Yeah, well, the indebtedness seems to be growing almost exponentially. If you look at the charts of the debt, and then relative to GDP, even as the government counts it, and I think there's some reasons for suspicion in that regard. But in any event, there was a report in Zero Hedge last Thursday of a near meltdown in the euro treasury markets. I don't know if you focused on that at all, but because almost nobody heard about it. There was almost nothing said about it, but it did. Zero Hedge reported it, and was reading something about it recently. Apparently, there was a very poor reception to French sovereign debt, and that triggered a German boon to rise very, very dramatically in rates, still very low rates, but nonetheless, to raise very dramatically, and that started to create a great deal of fear, and it started triggering an implosion. And apparently, they shut things down in the wee hours of the morning, and were able to push huge amounts of money back into the system. And when we woke up here in New York, everything seemed to be just fine and dandy again. The markets went on and behaved relatively normally, except that I've noticed that one of the things, Dan, I've noticed recently, I don't know if you if you really give it any importance or not, but the idea that we've seen the last couple of weeks at least money coming out of the equity markets and money coming out of the bond markets, whereas it used to be, whenever the equity markets were weak, money would go back into the treasuries and the treasuries would strengthen, interest rates would go lower. Do you think we could be at a turning point here, possibly?
Yeah, there's a lot there. Let me try to address some of those points. I mean, when you say that debt increases exponentially, that is its nature. Debt always increases exponentially until it crashes. And so I think what people at Zero Hedge are looking for is which snowflake is going to cause the avalanche, and it's impossible to know ahead of time which one it's going to be. But it's always interesting when you see liquidity dry up. It's a good signal that maybe this is the one, and so it's a good time to pay attention. Since really 2009, every time the markets have had any kind of hiccup, they've immediately bid higher and a lot higher because there's been this flood of liquidity coming in from various central banks. And so the market keeps getting saved every time it wants to break down. That's going to end soon. And yes, in my view, when you look back through the last 200 years of financial history, which has detailed records associated with that, and then even before that, you can sort of see semblances of this. As long as the banking system, as a system, is adding liquidity, markets go up. I mean, because it's a vicious circle, right? I mean, equity prices go up. It means that you get more collateral at your bank. You can borrow more money to buy more equities or more assets or more housing or more bonds or whatever you're buying. That pushes the price up, and it gives you more credit to buy more. So you get this positive feedback loop that powers things higher. But then as soon as credit starts disappearing from the system, that can go in reverse rather dramatically. The prices go down, you get a margin call, you have to sell. That pushes the price down more. Someone else gets a margin call, they have to sell. And so it's a positive feedback loop in both directions. And that's why the inflection point is so powerful, because when one loop turns into the reverse, you really get a whipsaw in markets. So in my view, the market needs consistent credit flooding into it, and since the taper began to cut that off, the Fed hasn't printed any money now for several months, and therefore one would expect at some point in the near future to have the unwind. What I would say, and what I think most Wall Streeters that I talk to, hedge fund managers and people like that, think is that yes, probably they'll get a big correction at some point because the Fed isn't printing money, but at some point, if that correction threatens to become real enough to actually be painful, Yellen will ride to the rescue. And she'll do it not because she loves hedge fund managers so much, but because she understands the connections between the economy as is currently oriented, the credit economy and the credit markets. And so she will not be the one to preside over an unwinding of the banking system and a crash of the market. So she will run to the rescue and print whatever has to be printed to make the market go up again. And if you think that, then it certainly changes your behavior, and you think maybe I won't, sell at the first sign of panic because I know she's there with the Yellen put, and that's probably not incorrect.
Yeah, I mean, some of us have not played that Yellen put. Some of us gold bugs have been stuck in gold mining shares for the last 4 years, and very, very sorry about that. We really have missed the boat, it seems, to a great extent. But what I hear you saying, Dan, is that the system almost needs more and more credit faster and faster, in a sense, because as more debt is added to the system, if we were seeing commensurate growth in the economy, and cash flow and GDP growing alongside with or in tandem with the debt creation, it wouldn't be so much of a problem, would it?
Well, let's be careful about that. I've never thought that GDP was a great metric for wealth creation. Remember, GDP measures activity. Okay. And what they do in China, for example, is some province thinks it'd be very honorable to have a bridge go across a river somewhere, and so they build it. And that adds to GDP, and it has all the trickle-down effects, right? You've got to buy steel, which means someone's got to buy iron ore.
Sure.
All those things. But if the bridge doesn't go anywhere, it doesn't create any wealth. And so the GDP metric is often a signal of frenetic economic activity with not productive activity. And you saw this very clearly, I think, in the run-up to the housing bubble, right? In 2006, everyone and their brother was running around building houses, and everyone else was selling them to each other, making commissions off of it. But it wasn't wealth-producing, and that was revealed in the crash of 2008. So, I think unemployment numbers, I think GDP, it tells you, again, how frenetic things are. It doesn't tell you how much wealth is being created and whether the activity is sustainable or not.
Okay, so let's say if we had real growth, but are you saying that with this kind of massive credit growth, you're not going to get real economic growth?
You'll get activity. You'll get lots of activity, people doing things, of course, but is it along the lines of consumer demand? Does it actually create wealth or not? And I would argue mostly no, right? If you look at historical credit bubbles, for example, in the 19th century, right, what would have? They built canals everywhere for 5 years, and then the thing would crash, and you realize, well, a canal to the middle of nowhere isn't worth anything. And then next, in 1857, it was railroads, right? They were building railroads all over the Northwest, which was great, except that no one lived there. And so when the crash came, it turned out these railroads were worthless. And so that's what happens in a credit bubble. Rational people are incentivized to do irrational things because the pricing system gets screwed up. The capital pricing system gets screwed up by the banks. And so the point is, those metrics you mentioned, I think, are not good indicators for wealth creation and whether the debt is sustainable or not. Debt is sustainable if and when the thing it's financing is productive and creates cash flow that can sustain the debt. But if you build things with that debt that aren't useful and don't create cash flow, then eventually people default on the debt, and the people who finance that run into trouble. I'm still waiting to find out who lent the Brazilians, hundreds of trillions of dollars to build oil platforms in the middle of the Atlantic, which now have very little value. Right? Someone made that loan, and they're not going to get paid back. And when they can't get paid back, they'll default to their creditors and so on and so forth. So you can't look at those metrics in a vacuum.
Yeah, well, it's certainly is true. I mean, just because your point is well taken, but we're being told, Dan, all the time. The mainstream media are telling us that basically, no, our economy is not as good as it should be. We got a long ways to go. President Obama will say we have a lot of work to do, but thanks to all this quantitative easing, we're in pretty good shape. What would you say to that notion, which we hear every day? Yeah,
I would just say go back and look at what Bernanke was saying in 2007, and when even early 2008, when the economy was already collapsing, and he's on TV saying everything's fine, that we've never had a circumstance where real estate prices fell in the entire country. Of course, he really meant since the Great Depression, right? Obviously, it happened then. But all the policy, even Yellen, who was trumpeted by the New York Times for seeing that things were overpriced, basically said near the top that things are already corrected as much as they were going to. So, what they're saying now, of course, has nothing to do with reality. It has to do with the fact that you print a lot of money, you create a great party, people do lots of things, and it feels good. But economics isn't based on what people feel. It's based on value and consumer demand. And if the activity doesn't create value and doesn't satiate consumer demand, eventually the market will liquidate it. And that's what will happen in the next crash. And I would add, Jay, that, as you point out, the amount of debt in the system today is vastly higher than it was in 2007. The BIS says this, all the metrics show that. And so what that means is that when the next crisis comes, and it will come, and it may come soon, the Fed is going to have to intervene correspondingly greater than it did last time. And don't forget that Bernanke took the balance sheet of the Federal Reserve from $800 billion to $4+ trillion. But the real story was during the crisis, he issued, I think it was $18 trillion in that range of guarantees. Right. They weren't triggered. They went away, but they could have been triggered. They just weren't. My guess is that because that quote-unquote worked last time, in the next crisis, Yellen will say, hey, we know the game plan. We know what to do. We've done it before. It works. We'll do it again. And so that will be issuing massive amounts of guarantees to make sure that the banks don't collapse, plus money printing to shore up their balance sheets. And the risk, of course, is that you do that one too many times, and people do call your guarantees. And all of a sudden now the monetary base doesn't go from 800 to 4 trillion. It goes from 4 trillion to 30 trillion overnight. Right? That's the risk. And that's, I think, the risk they will run because they'll have very little choice when the next crisis comes.
That at some time you'd expect confidence then to be broken down, you would guess. Oh, but I would have thought it would have happened before now, Dan.
Well, I mean, don't forget that when the Fed prints money, it doesn't give it to you and me to spend, right? It gives it to the banks, and the banks use it to lend out to people. And who do they lend it to? They lend it to governments because it's safe. They lend it to hedge fund people because they're very liquid and they can yank their credit if they want to, right? So that money gets magnified through the bank system into particular activities, most of which are wealth destroying, right? Like when they finance the government, for example. So And that's why you see papers from various left-leaning organizations that say, hey, the next stimulus shouldn't be to the banks, it should be to the people, right? Write everyone a check for $1,000 and they can go have a good time. If they do that, right, I mean, that will create a lot of consumer good inflation immediately. But the point is that the QE programs up till now have been designed to affect the capital markets, and they've been very effective. The capital markets have gone up a lot. And so what that has done is create all sorts of malinvestments, which will be liquidated. And the consumer price inflation will happen if and when that money lands up in consumer pockets, not in not in the purview of the capital markets.
Yeah, interestingly enough, in your April 21st missive titled "Quoth the Fed Nevermore," you pointed out there was a very interesting chart there that showed that loans are being turned down, I think, in record numbers. And yet credit is growing. But can you explain that? What's going on there? Who's getting the loans and who is being turned away?
Yeah, sure. It's very interesting. Same thing happened right before the last crisis, and it reflects something that I think most economists miss, which is that the whole point of lowering interest rates below their national rate is to make it seem as though more savings exist than really do. So businesses all run out and they start doing things they shouldn't do, like overbuilding buildings and building too many ships and too many factories and so on and so forth. And what happens is when the resources start to run out, right, and the companies can't get the resources to finish their projects, their choices are to either abandon them, right, and leave them half finished, in which case they're worth nothing, or to continue them. So they go to the banks and they say, hey, look, we know that this project was a bad project, and maybe you shouldn't have let us have money to begin with, but we've already built 80% of this thing, and so you might as well just finance us to finish it. And the banks are there thinking, hey, if I don't finance this guy to finish the project, is a total wipe-off, right? I mean, figure out the sunk cost, right? I mean, the incremental loan finishes the project, at least I have something. So what happens is that to existing customers that are finishing projects or have projects underway, the banks become very liberal because they're so worried about a total write-off. But to new projects, they say, forget about it. We don't want to finance new projects. But what happens... What happened in 2008, of course, was that as all these companies scrambled for resources to finish their projects, you saw commodity prices absolutely spike, right? And everyone said, the mainstream economists said, look, things must be healthy because there's a huge demand for these commodities. But no, things were not healthy. Things were already collapsing. The demand for commodities was due to these, Johnny-come-latelys desperately trying to finish their projects before the music stopped. But of course, by definition, they couldn't because the resources didn't actually exist. That's the point of the capital markets, is to allocate resources, and what the Fed does is it muddies those signals. So, I think what's interesting to me is that you see all sorts of signs that the economy is rolling over, and yet in the last little bit, base commodities have been in a tear, right? Well, I mean, that would be consistent with the idea that the economy is rolling over, and so banks don't want to lend for new projects, but they are willing to finance old projects. They just need a little bit more help to get their projects done, even though they may not be performing or as valuable as the banks thought they would be originally. And that's usually a sign of the end of the cycle.
Dan, with just a couple of minutes left here,
Sure.
Why do you think gold is behaving so poorly if the economy's in such dire straits?
Well, it's interesting. If you look at most gold markets, they don't move in curves, right? It is not the case. Like in the 70s, there was a nice parabola, and we saw a parabola from 2001 to 2011. That doesn't usually happen. What usually happens is it moves in a quanta, right? It goes along doing nothing, and then one day it opens up 30% higher. And that's, if you look at in this century and previous centuries, these currency crises seem to hit out of the blue. I think the reason gold's not doing all that great right now is, again, there's a huge shortage of dollars. The Fed stopped printing them. Interest payments are still due. People need dollars, and so they sell the assets they can that seem to be underperforming, like gold, to pay their interest payments. But at some point, of course, when the system starts to wobble, either because the Fed prints a lot of money or because people don't want to be in the dollar system at all, that's when gold will really take off. And my guess is the next move in gold will not be a nice smooth curve higher. It'll be a big jump higher, and most people will miss it.
No. On that, we're going to have to leave it at that, Dan, because we're out of time. Thank you very much. I might tell our listeners, go to Myrmikan Gold Fund. There's a website, Myrmikan Gold Fund. Is that the website?
Myrmikan.com.
And it's really good to go there because, and that's spelled Myrmikan, MIKAN. Go there because there's a lot of very interesting things that Dan publishes, things that I didn't realize were up there. His research reports, which are really worth reading if you're serious about the economy and what's going on. Do yourself a favor and go there. Well, that's all the time we have for this week. Thanks, Dan, for being with us.